As more companies sort of delay employees' return to the office, how much more of a negative effect will this have on offices and commercial real estate?
Well, this is certainly going to delay the recovery in the office sector. The office sector is one of the few areas in the REIT universe, in commercial real estate, traded commercial real estate, that has not recovered fully. And that's because the return to the office has been delayed. Um, and I would like to point out, though, that many times people are asking the wrong question. It's really not a question of are people coming back this month or next month. We keep pushing it back as the pandemic has another wave of the variant. The real question is, will there be a long-term impact on the demand for commercial real estate? And here the picture is actually much more mixed or even favorable for commercial real estate. What you need to keep in mind is that offices are still going to need to have the amount of space for the days when everyone is in the office. Many employers are embracing a flexible work from home type environment where people can phone in and do things online when they need to. But if they're going to be there on team days, collaboration days, or so on, the employers are going to need to lease the amount of space for the days when everyone is there. It'll be just less dense on other days. So that suggests that once we get past this next, I'm not sure how many months, you're going to see continued rebound in the demand for the office sector.
So which cities are performing better than others I know tourism has picked up in New York City, for example, which is currently the hottest hotel market with an average occupancy rate of around 81%. Is New York doing better on the office front as well?
Well, the real difference in the hotel and lodging sector is the business versus the personal travel. And actually, leisure travel rebounded fairly quickly. And you can see this if you look at occupancy rates on the weekends. People were saying over Saturday night, those hotels are much closer to being full, whereas midweek, the business travelers have been slower. And New York has been slower there, San Francisco, many of the areas where your traditional centers for business activity have been slower to return, which is normal just because we're really not back to speed in terms of interacting in public, and that includes business travel.
Other
We
parts of
expect
the
that to
real
come in the next half of the next year, though.
Yeah, that's a great point. I was going to say other parts of the real estate story are working very well, and that includes industrial, self-storage. How did those markets do in 2022?
Well, they're poised to continue doing quite well. Some of the sectors you mentioned, the industrial, is actually the logistics sector as part of the industrial. This is supporting the e-commerce business. They operate the parts of the supply chain that get the goods the last mile in position to be the last mile to consumers. Obviously, that's been a very strong business. Plus other tech-related REITs, the digital, the data centers, the cell tower REITs. What's been really interesting is they had a surge in demand early in the pandemic when everything shifted online, but that demand has continued to grow from a high level even as the economy opens up. This is saying there are permanent changes in the way people are doing their business, they're doing their lives, permanent changes in the demand for commercial real estate. These sectors look very strong, the logistics, industrial, data centers going into 2022.
I know there's been a lot of questions about what higher interest rates mean for residential housing. There's been this huge housing boom since the onset of the pandemic. What do you think 3 interest rate hikes next year mean for industrial, self-storage, these other parts of real estate?
Interest rates are still quite low and are likely to remain low. And what's really important for the commercial real estate sector is the long-term interest rates, and they've not moved up in anticipation of the Fed hikes at the short-term end of the yield curve. And that's because people are looking, many investors are looking at this inflation surge as being something that is related to the supply chain bottlenecks still, not expecting it to be leading to higher long-term interest rates. Now, on top of that, REITs lowered their leverage, lowered their interest rate exposures after the financial crisis in 2008, 2009. We have data in the NAREIT T-Tracker on REIT.com that shows that leverage ratios are down significantly from where they were a decade ago. And they've locked in low interest rates for longer term. The average maturity of debt is the longest that we've ever seen. So REITs are well protected for the current interest rate environment.